and welcome to the financial reporting process. In this video, we are going to identify the role of accounting information systems in financial reporting. First, let's start off with financial reporting. It's a standardized practice that produces external stakeholders, like investors, with an accurate depiction of the company's financial situation. The results of a company's financial reporting process is typically a set of formalized financial statements, which in the order of their completion is the income statement, the balance sheet, the statement of stockholders' equity, and my favorite, the statement of cash flows. There are two key financial reporting roles. So first, we see that the CFO oversees all financing related activities. So the CFO usually participates in strategic development and overseeing like the internal audit and being the key decision maker that is also part of the executive management team and being responsible for financial reporting, tax, budget, cost benefit analysis, and the financial forecasting, whereas the controller of an organization focuses specifically on the accounting process. So they oversee all of the accounting activities such as payroll and maybe accounts receivable. They also oversee managerial accounting, maybe tax, and they collaborate with management and other accounting functions to make sure that we have a strong control environment. Now, we want to be meeting our financial reporting objectives. So the financial reporting process produces the financial statements, which is typically given to external users. The financial statements must present in all material aspects the financial position of the business at a specific point in time, typically by the balance sheet, and the results of its operations, the income statement, and cash flows over specific reporting time periods. So that's usually by the statement of cash flows. Then we have decision usefulness. So financial accounting information only serves its purpose if it's useful for making decisions. So the Financial Accounting Standards Board, FASB, identifies these characteristics which are fundamental and enhancing the quality information for financial information. So to meet this objective, we have decision usefulness, which is information that must have these characteristics. So we have relevance and faithful representation or accuracy. So with relevance, we're looking at predictive value, materiality, and confirmatory value. With faithful representation, we have completeness, neutral, and hopefully our financial statements are error-free. So these enhancing characteristics then help us, such as comparability or consistency, verifiability, timeliness, and understandability. And all of these qualitative characteristics are part of the Statement of Financial Accounting Concepts that is part of our FASB codification. Then we move on to cost effectiveness. So the cost effectiveness of accounting information is determined by weighing the costs of providing that information against the value that that information is providing. So examples of these costs can include when we are gathering the data or processing the data, storing the data, and then communication of that data or that information. Then we move on to consolidated financial statements. So these are the financial statements of a company that has either multiple divisions or different subsidiaries. So from an accounting information system reporting perspective, consolidations add another layer of complexity, especially at the fiscal year end when timelines are tight. And also with consolidated financial statements, we have intercompany accounts, and we need to make sure that everything is recorded as it should be. So when we are looking at subsidiary companies reporting, we have to prepare consolidated financial statements according to FASB and US GAAP. So we would have the parent company, and then we would have the subsidiaries, and we have to make sure that those subsidiaries are actually trued up to the parent company. So Effective consolidation software includes several functionalities. First, you might map multiple general ledgers to a single chart of accounts. You might also determine the hierarchies of controls. You might also have to deal with multiple currencies or intercompany transactions. You might also have to generate the consolidated financial statements, and it also should integrate XBRL, Existential Business Reporting Language. And that concludes this lecture. Thank you for watching.